Hello everyone, this video is about the cash outflows in relation to GST. So first of all, it's going to go through the idea of checks. So the reason that people still tend to use checks is for the following reasons. So for security, to avoid carrying large amounts of cash around. So it is dangerous to carry large amounts of cash around. I think it's all pretty obvious as to why. Traceability. So if we're thinking about source documents, the ability to then trace that back to what's actually happened, what's been paid, who's it been paid to, etc. And verifiability. So all payments are recorded in the check butt. So we're able to verify what's actually happened. Okay, so cash payments on the GST. The amount of the GST should be documented on the check butt. So please remember that the source document when we're talking about checks is the check butt. It's not the check itself. The check itself is going to go to the person we're paying. The check butt stays with the business. GST does not charge the amount of what has been purchased. Change the amount of what has been purchased, sorry. It will decrease the amount of the GST liability. So again, as we spoke before, if we pay money out, we're going to decrease the liability because we've paid the GST out as if we've paid the ATO. So to prove the transactions happened, the ATO requires the check butt as well as an invoice issued by the supplier. So you have to have a check butt from your own records, but you also have to have an invoice that the supplier has given you to indicate that's how much you owe. Okay. So we've got an example. Snaps Photography paid $1,200 plus $120 GST to the insurance company for a full year of insurance. So with the method that we learnt last week, we would increase our prepaid because we're increasing the asset because we have a future economic benefit that we're able to use, and decreasing the bank. So the bank needs to be decreased for $1,200. The prepaid insurance needs to be increased by $1,200. Debit, credit, both sides are equal. Then we post this out. So the bank, we're going to put our credit entry in. Our opposite side is going to be prepaid insurance, and our debit entry is going to be the prepaid insurance. Our opposite side will be the bank. Now, this time, we need to consider what's happening with our GST. So we're going to do essentially the same thing but include GST. We have our prepaid insurance. This is an asset and it is increasing. This is increasing by $1,200. This is how much it costs to take this insurance out. Our GST clearing is a liability. It is decreasing. We are paying out this amount of GST, therefore we no longer owe the ATO as much, and it is decreasing by $120. Our bank is the last thing. It is decreasing. However, it's decreasing by the total amount that we are paying out. So 1,320, the full amount that we've had to pay, including the GST. So if we put that down now, our bank, we've got, with the date in here, sorry, we're going to do the 31st of Jan. Now, the two other accounts that are getting affected, prepaid insurance and GST clearing. So 1,320. So our prepaid insurance is one side of this transaction, and our GST clearing is the other side of this transaction. So it needs to have both of these debited. So our prepaid insurance, 31st of Jan. Bank is the credit side as a result of this debit, 1,200. GST clearing, bank is the other side of this debit, the credit. So the total of these two add to the amount on this side. So our debits and our credits are equal. There are a number of cash payments where a check may be issued, but they don't have GST on them. So they don't have any GST transactions on them. Payments to creditors, really important. If we're pulling GST on a credit purchase, it's going to happen at the time the purchase is made. It's not going to happen at the time the creditors pay, the time the purchase has been made. Interest expense has no GST. Wages has PAYG tax. Council rate, cash drawings, loan repayments, none of those have any GST on them. Okay, I'm just going to discuss credit sales really quickly. I'm not going to bother going through an example because the example is exactly the same as the cash sales that we did before. However, instead of bank, it's going to be debtors control. So we know that credit sales can occur when the stock has been sold and given to the customer, but the customer still owes the business for that stock. So the source document is a sales invoice, very important. There is a difference between the purchase invoice and the sales invoice. So other than this, the only difference between cash and credit transactions is that the bank is not used. The rest of the transaction will be exactly the same. So it says it down here. Instead of the bank in a credit sale, debtors control will be used. Don't forget to say control, debtors control. This means that the debtors will increase by the full amount due. So the debtors have to pay the full amount that they bought the stock for and the GST. This will increase the GST liability as the business is holding on to the money for the ATO. So the GST liability is going to go up in a credit sale, just as it did in a cash sale. Just as a note down here, instead of the bank in a credit purchase, credit control will be used exactly the same way as the idea of credit sales is happening. So you need to make sure that you understand this one, and it will be exactly the same as what we did in chapter 3, except we're adding GST in now, the same way we've added GST into the other transactions. So I've just got a quick little example down here. So remember what the credit terms mean. So the terms here are 5/7N/30. 5% if paid within 7 days, so 5% discount if paid within 7 days, or the net amount due in 30 days. The other thing to note from this invoice is whether or not it's a sales invoice or a purchase invoice. Because this has Snaps Photography, which is the company that we are talking about in all of our transactions, this is going to be a sales invoice. The person who is at the top of the invoice is the person who's selling the goods. Okay, so when goods are purchased on credit, we're going to go through an example quickly. We have the supplier will issue a purchase invoice. As we said above, the sales invoice is when we sell something, and the purchase invoice when we buy something. I've gone through this here. The heading is where we need to check who the invoice is being issued by in order to tell whether or not it's a purchase invoice or a sales invoice. Okay, on the 28th of April, Snaps Photography purchased 10 cameras for $270 each. So 28th of April. Now the account that's going to get affected, our stock control is going to go up. We are buying an asset, so our stock control, buying stock, so we have more stock in the business. So it's going to go up, and it's going to go up by $270. Oh, sorry. It's going to go up by $270 times 10. We've bought 10 cameras. It's going to go up by $2,700. Now, the next thing that happens is we need to account for our GST. It is going to be this is an asset. This is a liability. This is going to go down because we are paying out GST. We no longer have that GST. We're no longer holding on to that GST. for the ATO. So it's going to go down. To decrease the liability, you're going to debit. Now, the lucky last, it is a credit purchase. So we have creditors control. The liability, it's going to increase because we are paying for more, so we owe those creditors. So 2,970, our total credits equal our total debits. Now we just need to chuck this in. So our stock control is going up. It's a debit. We know it's a debit because we've done it here. So the 28th of April. The credit side to this debit transaction is creditors control. Now our GST clearing, it is a debit as well. So on the 28th of April, creditors control is going to go down by 270. Now this needs to be changed from bank to creditors control. We're going to have the 31st of Jan, the 28th of April. The two credit sides as a result of this, the two debit sides as a result of this credit are going to be stock control and GST clearing. And the total amount that we need to do this for is 2,970. So this one and this one added together, the opposite side is the 2,900. So this is talking about how we are affecting the GST liability. It's going down because we are paying the ATO, therefore we don't owe them as much anymore. Okay, so I'm going to stop this video here. I'm going to do a very, very short video on the GST clearing account.